Before we dive in, a quick note. You might notice that certain product names in this video have been edited or dubbed. This was done after recording at the request of one of the separate account managers we work with who asked us to remove references to their trademarked name. While the terminology has been adjusted, the strategy and insights we're discussing remain the same. Throughout this video, we'll refer more generally to tax-aware long-short, separately managed accounts, or SMAs. When you hear long-short overlay, don't think risky black box Wall Street hedge fund. Think smart farm management, a little borrowed land, a little insurance, a lot of thoughtful coordination. Hi again. I'm Hilary Hendershott, CFP, and founder of Hendershott Wealth Management. This is video number 3 in a 7-part series about the tax-aware long-short strategy we deploy within our ultra tax-efficient wealth management suite of services, and, in particular, how it's engineered to deliver tax alpha. That's higher net returns that don't come from investment performance, but rather from smart tax strategy. That's strategy that minimizes your capital gains taxes without adding much additional risk to your risk profile. If your eyes glazed over at that, or when I said long-short overlay in earlier videos, or if the idea of leverage still makes you feel uneasy, I get it, and you're not alone. These concepts are often misused, misunderstood, or both. So let's back up now and try a new lens. Let's look at what tax-aware long-short has in common with farming. Because believe it or not, how we use market-neutral leverage in our tax-aware long-short strategy has a lot in common with a well-run farm. Once you understand that, the idea of market-neutral leverage will feel a whole lot more grounded and way less risky than you might expect. All right, let's go to the metaphorical farm. Let's start with something familiar. Your core investment portfolio. Within your core portfolio, you own stocks. If you're like our clients with strategically diversified portfolios, you might own stocks from up to 12,000 different companies around the world. These are your long positions. If you own these stocks when they go up, you earn a profit. Think of this long-only portfolio with stocks, ETFs, or mutual funds as your home farm. You own the land, you buy the seeds, which are the stocks, you plant them in good soil, that's your portfolio, and you wait for the harvest. More often than not, the weather is good, markets go up. Sometimes you get a late frost or too much rain, markets dip. But on average, with enough patience, smart planning, and good practices, you do well year after year. This is your basic, solid investment strategy. No borrowing, no added risk. Just planting and waiting. Or in our case, time-tested, diversified investing that grows wealth steadily through compound returns over the long term. Now imagine you want to grow more crops faster. So you borrow money using your existing farmland as collateral, you lease extra fields and plant more of the same thing. If the weather's great, your harvest doubles. But if there's a drought, a flood, or a swarm of locusts, you're worse off because you've magnified your risk. This is traditional leverage, investing borrowed money in more of the same. You get exposure, but you're also more vulnerable to whatever the market does because it amplifies whatever the market gives you. This is the kind of leverage that makes people nervous, and for good reason. Used poorly, it can cause you to lose the family farm, and that's why it's risky. You introduce more exposure without a safety net. Here's where our long-short strategy flips the script and removes the risk. We still use modest leverage to borrow, lease extra fields, and plant crops. That's our long overlay, borrowing against our home farm to create additional investments. But now, we buy crop insurance, which is like our short overlay. If the weather turns or there's a market dip, the short position is designed to kick in and produce a gain that offsets the loss on the long side, like the insurance payout if your crops fail. In a drought, our farm does poorly, but the crop insurance covers most of the losses. If the weather's good, our harvest doubles. And while we still pay the insurance premium, it's a tax-deductible expense. Even better if we plant different drought-resistant crops on the extra land. Maybe we actually do okay in a dry year because we're diversified. The actual portfolio leverage implemented in the tax-aware long-short strategy we deploy is even better because we're able to realize the losses from the drought for tax purposes while pushing our profits and tax bills off into the future. With tax-aware long-short, you get 1, a core portfolio that grows over time, 2, extra return potential and tax alpha from the long overlay, and 3, downside protection and additional tax alpha from the short overlay. So, while traditional leverage amplifies risk, our strategy buffers it because it's market neutral. It doesn't rely on the overall direction of the market to work, with both the long and short overlays either producing gains or harvestable losses simultaneously, no matter which way the market's trending. Even though we're using borrowed money for the long-short overlay, which sounds risky, the risk is actively hedged and managed. This isn't about taking wild bets. We're using a strategy that produces losses on purpose and in a way that benefits you on your tax return, and therefore in your bank account, without actually shrinking your portfolio. Again, that's tax alpha, higher net returns that don't come from investment performance, but from smart tax strategy. The long-short overlay trades hundreds, sometimes thousands of positions using systematic, rules-based investing, and it's all designed to produce realized losses that you can use at tax time while your real-world wealth continues to grow. We're not guessing at market trends. We're building a diversified, risk-balanced overlay that works with your core portfolio, and we've seen this strategy's ability to turn a $9 million IPO windfall into $20 million by almost completely eliminating the tax bill today and allowing that tax savings to compound instead of running out of money at age 65. Save an investor $4 million in taxes as she diversifies her Apple and Amazon stock going into retirement, and allow for an additional $240,000 in annual spending for 25 years. And allow a retired couple to draw tax-free income from their portfolio for 25 years while still leaving a meaningful legacy for their 3 children. Implementing a tax-aware long-short strategy in your financial plan is about using every available tool to grow wealth smartly and reduce tax drag without letting mistakes or natural disasters derail your plan. Just like modern agriculture uses monitored weather systems, diversified crops, irrigation controls, and a little insurance for good measure. The borrowed fields with added crop insurance are not about going big or going broke. They're about building that market-neutral long-short overlay to generate significant tax losses that create long-term wealth. That's the kind of thoughtful leverage we're talking about. When you hear long-short overlay, don't think risky black box Wall Street hedge fund. Think smart farm management, a little borrowed land, a little insurance, a lot of thoughtful coordination. That's how we use leverage to help suitable investors reduce tax drag and build lasting wealth without risking the family farm. If you believe you're a suitable investor for this strategy, that is, if you have at least $1.25 million in a taxable account and you want to see whether this kind of strategy is a fit, we'd love to talk. Head to hendershottwealth.com/contact and book a 45-minute Discover call with a lead advisor on our team. We'll learn about your goals, review your tax exposure, and help you determine whether the strategies within our ultra tax efficient wealth management offer, including a tax-aware long-short strategy, can give you more freedom, flexibility, and peace of mind. And if we're not the right fit, we will point you towards someone who is. And in the meantime, jump over to video 4 in this series to keep learning more about how the tax-aware long-short strategy works, this time with an analogy from the kitchen.